Credit card debt increased by $39.6 billion during Q3 of 2022, reported by U.S. Census Bureau Federal Reserve. Take a look at this. The average household's credit card balance is $9,260. Bloomberg reported this month more Americans are tapping into their credit cards for everyday expenses, especially coming into the holiday season. Yes, households are feeling the pinch as more Americans are relying on money outside of their regular income sources to meet spending needs in the past week. The path of home ownership with all this credit card debt piling up can seem like a pipe dream, almost impossible to overcome. Well, I've invited a special guest to help us understand how credit works and show you that home ownership is still possible with bad credit. You just need the right team to help you adapt and overcome.
I do feel like the timing is good. It's January, and maybe we went a little overboard with our Christmas shopping this year, and so some credit repair might be necessary. But when we're talking about like understanding our credit and what it is and what it isn't, it's more than just, oh, I ran up my credit card. Your credit score is going to be the major, the major influence on whether or not you can qualify for a home loan. I don't care how good your credit is. I don't care how bad your credit is. At the end of the day, you're going to have a credit score if you want to obtain financing to buy a house. First, let's define what credit is. Credit is your financial resume. Omar, imagine if you were to try to go and interview for a job and someone asks to see your resume and you're like, trust me, I'm very experienced. They'd laugh you out of the room, right? So that's what your credit is. It's essentially your financial resume letting everything from lenders to employers know just how worthy are you if you were to be entrusted with money. It also, what's credit, it lets you know how much you borrowed, it lets you know who you've borrowed from, and then more importantly, it's going to let others know how well you've been able to repay your debt and repay that debt on time. Why do you want that? Think about if you're doing a job interview, why do you want a really good resume? So conversely, why would you want a really good credit score? So for our purposes, it's obtaining a lower interest rate. Now, whether it's buying a home or a car or getting a credit card, the higher your score, the lower your interest rate. And what is interest rate? All an interest rate is, it's the cost associated with borrowing money. But beyond just that, and I have them listed here, having good credit is important for employment. There are a lot of employers that will not hire you unless your credit score is over a certain number. Also, if you're trying to lease or rent a property, you oftentimes have to have a minimum credit score. Let's say you're trying to just establish utility services, got to have credit. And if you're trying to obtain insurance, whether it's life insurance, term insurance, sometimes even car insurance, if you're trying to get like a deluxe package, you've got to have good credit. So what we're going to talk about is going to be specific to buying a home. That being said, good credit is really important and it's pretty universal in all sectors. When we say credit, what we're actually talking about are credit reports, and there are three types of them. You've got a consumer credit report, you've got an in-file credit report, and you have a mortgage credit report. Now, you may already have something, Omar, like Capital One Credit Wise or Credit Karma. These credit score monitoring software platforms, they are going to really focus on this consumer credit report. Now, I listed these from the reports that are typically going to give you the highest credit score to the lowest. The mortgage credit report and how your credit score is calculated when a lender like myself pulls your credit, you're going to get it's going to be the toughest. It's going to be the toughest report on your credit. So what does that mean? That means if you're logged into Capital One Credit Wise or Credit Karma or wherever you monitor your credit, go ahead and deduct anywhere between 10 to 20 points. And that's probably what your credit score is going to be if a mortgage lender were to actually pull your credit. And last but not least, when it comes to types of credit, you've got three major credit bureaus. You have Experian, TransUnion, Equifax. Have you ever heard of something called FICO? FICO. If you have, and it's the most popular one, that's Experian. All right. The FICO credit model is also the model that's easiest to get a higher score on. And Omar, whenever you're trying to buy a home, you can't just have one of your three credit reports have a high score, because what every single mortgage lender is going to do is they're going to throw out your high score, throw out your low score, and they're going to take your middle score. So understanding these three credit bureaus and these three different scoring models, super, super important when understanding what you need to do to have an incredibly high credit score across all three bureaus.
Wow, I always wondered that if what I was seeing, because I have Chase and USAA and they have their own little credit reports, if that was any
Yep.
different from what you guys see on your end. So you guys are, I guess, keep in mind, extra tough because you guys are looking at risk and just the quality of the borrower.
Absolutely. Now, here's what I will say, Omar. Sometimes, uh, let's say, for example, a medical collection, right? Let's say that you had a medical bill, life happens, you weren't able to pay it, and it was reported to collections. That is not nearly as important to me as a lender. We actually, most loan products, we are excusing or excluding medical collection debt, and it's going to not have nearly as high of a weight on that credit score number. Okay. That being said, versus if you were doing like an in-file report or a consumer credit report, if you have any collections, medical or otherwise, it's going to have a huge, huge impact negatively on your score. But on the flip side, let's say you're like, you know what? I forgot to pay my credit card last month. Shoot. Like, oh, I forgot to pay that other credit card, but whatever, I paid it now. You're like, I had two late credit card payments. Not a big deal. Late payments are a huge deal on your mortgage credit report. So at the end of the day, you really want to make sure that you're making those payments on time. But no, yeah, you're exactly right. And you may be wondering, how am I supposed to know what my score is? Well, again, whether it's Capital One, Chase, USAA, they're not doing hard pulls. What they're doing is they are doing called soft pulls or soft inquiries, which do not impact your credit. But there's a, which is good. You don't want your credit to go down from a bunch of hard pulls. That being said, you are, and this is a legal right that you have as a US citizen. You are entitled to a free credit report every single year. And you will get all three credit reports, all three types. And there's only one place that you can order this free credit report. If you go anywhere else, you're getting ripped off. It's www.annualcreditreport.com.
Hmm.
Okay. So if you haven't done that, make sure you do that and go ahead and set a recurring calendar invite. So invite yourself to hopefully a really fun yearly party, which is January the 6th. Every year in January the 6th, I'm going to get my free credit report at annualcreditreport.com. But this right here, Omar, so, so important to do. If you're watching this, go to this website and get your free credit report. Do not rely solely on the Capital Ones, the USAAs, the Credit Karmas. Those credit monitoring tools, they're tools, really important, but they're not going to give you the full picture. Does that make sense?
Oh yeah. Oh yeah.
So, what do these scores actually mean? At the end of the day, it's like a statistical category that is lumping borrower types to how creditworthy are you or how much can we trust you. Now, you'll notice, and this kind of drives me crazy if I'm being honest, I have people who really take pride in their credit. I love that. That doesn't drive me crazy. What drives me crazy is I literally had a borrower a couple of months ago say, yeah, I've been putting off buying a home because I was determined to get my credit over an 800. In
Hmm.
reality, not just for mortgages and home loans, but for your cars, your credit cards. By the time you get over a 740, AKA you're in the green, it really doesn't matter. It really doesn't. As long as you get over a 740, you are going to get all the perks of somebody who's going to be in the 800s. That being said, if you're in this yellow range, 670 to a 739, then you know what? And if you feel like, okay, if I can just pay down this credit card, I'll be able to get up into the 740s, that might be worth it. But please, if you're like that high achiever, gold star, teacher's pet, like triple type A, and you refuse to buy your dream home because your credit's sitting at a 798 and you really want to get an 800, really all you're doing is just hurting yourself. So, but these are your different score ranges. I know it says FICO, which is associated with Experian, but all of your credit bureaus are going to use the same range, which is 300 to 850. And to answer your question, Omar, that you have not asked yet, no, I have never seen an 850 credit score. And I also have never seen a 300 credit score. So, perfection on either side of this scale, I've never seen. And I think that's by design.
Fair enough.
So, how do you actually get these scores? This is, I mean, if you're watching this, take a screenshot, pause it, write it down, whatever you need to do. But these are the categories that make up your credit score. And I'm using FICO because it's the easiest to understand. TransUnion and Equifax have slightly different scoring models, but FICO is the one that's easiest to understand. And if you follow this model, then it will have a positive impact on your TransUnion and your Equifax. So, first and foremost, Omar, I'm going to call on you. Which category are you like, oh, dang, I got to get this category right if I want to have good credit?
I would say the amount owed.
Say that again.
The amounts owed for 30%.
Oh, huge. That's huge. But there's one that's even more important.
Is it the highest number? The payment history?
Yes.
Okay.
And I'm gonna say that. Here's the thing. Payment history. Payment history, payment history. Like I've had people who've wanted to get out of debt, and so they will not pay any of their credit cards because they want to pay off the credit card with the highest interest because they're trying to like snow. And that's look. At the end of the day, that is smart, but not at the sacrifice of not making your minimum payments on the other cards, right? And so you are going to shoot yourself in the foot if you are not having on time payments. So right now, pause this, go set up an auto draft on all of your credit cards, on all of your installment loans. Make sure you do not have any late payments because that is the big chunk of the pie. But Omar, you're right. The amount, the amount that you owe, that is the other big piece of the pie. And I know that we're not math geniuses, but if you just make your payments on time and the amount that you owe, your credit utilization is lowered, that's 65% of the pie right there. And why is that important? Well, it's important because uh, a lot of folks, Omar, will carry high balances on their credit cards and then they'll get freaked out about me pulling their credit. Well, based on this scoring model, new credit or credit pulls is only going to make up what percentage of the scoring model?
Okay, so I've always heard just different stories. So now we could put this myth to bed. So if
That's
you're
right.
applying for a new credit card, it's a soft pull, so it's not gonna affect your credit that dramatically.
That's exactly right.
Okay.
And even if it is a hard pull, even if you do get a hard pull, at the end of the day, it's only going to impact your score or represent, it's only 10%. Like it has such a low impact on your total credit. And so that is really, really important is don't obsess over your credit pulls. You don't want to you don't want to have too many pulls, obviously. What you need to obsess over, making payments on time, and then bringing down your credit utilization percentage, which going to our next slide, I am not going to read this to you except for one section, and that is your revolving debt ratio. It's on the left-hand side of the page. What revolving debt ratio means is amount owed versus overall credit limit. So here's how you do it. It's a game. It's super easy to play too. Log on to your credit card, whatever online portal you use, and don't look at the balance. Don't look at the balance. What I want you to do is I want you to look at the limit, the credit limit. All right. So let's just say, I want you to imagine here, I open up my Capital One and I've got a credit limit of 10,000. All right, cool. Now I'm going to go over to my Apple Card. Okay, my Apple Card, and I have a credit limit of 40,000. which by the way, I don't, but that'd be pretty cool. But I got a credit limit of 40,000. So 10,000 my Capital One, 40,000 on my Apple Card. That's my credit limit.
Okay.
Now, if I ignore those credit limits, meaning I don't know what the credit limit is, and I'm just looking at the balances, okay? Let's say that I have a $4,000 balance on my Capital One, and let's say that I have a $5,000 balance on my Apple Card. Most people are going to pay which off first? They're going to pay the one with the higher balance. They're going to pay their Apple Card, the one with the $5,000 balance. Here's why that's not a good idea if you had to pick. Because remember, your Capital One, it only has $10,000 limit. And so by you having a $4,000 balance, you are utilizing 40% of that credit line. All right. Over on Apple, we have a higher balance. It's $5,000 balance, but our credit limit is 40,000. Meaning, even though our Apple Card has a higher balance, because our credit limit is higher, we are well below that 30% utilization threshold. Okay.
Ah, okay.
So here's the smartest thing that you can do. One, don't be in debt, of course, but practically get yourself a little spreadsheet, list out your credit cards, and then don't do the balances first. Type in your credit limits. Okay. Type in your credit limits, then type in your balances, and then figure out for each of your cards, am I below or am I over that 30% credit utilization threshold? Because if
Okay.
you can just get that below, if you can get each card below that 30% utilization threshold, I'm telling you now, your score, your credit score will skyrocket. All right. Um, Another hack. You ready for this?
Hit
Increase your
me.
credit limit. Increase your credit limit. Capital One, Apple, most major credit card companies, it is so easy. Like, hey, I got a raise at work. Or, hey, X, Y, and Z happened to me. Or, hey, I've had your credit card for 5 years. I want my credit limit increased by 5,000 or 10,000, whatever. 9 times out of 10, they will increase your credit limit, which means you could boost your credit score significantly by literally not paying a dime on that balance. So just by increasing your credit limit and not doing anything to your balance, your score might go up because that credit utilization of 30%, all of a sudden that balance may drop below that 30% because you got your credit line increased. And before you ask, no, getting your credit line increase, it does not require your credit to be pulled. So you risk nothing. You risk nothing at all asking your credit card companies to increase your line of credit. Okay.
I I've
Does that make
actually had.
sense?
Oh yeah, 100%. I've actually had them just do it just cause sometimes.
Yeah.
Just cause.
Just cuz like it's been a
And
while.
and to your point, um, what they typically have asked me is, what's your income? And if you tell them you got a raise, or you tell them, it's different from when you first applied, they're gonna take that into account. And that's like, I think, really the only question that comes off the top of my mind that they ask,
That's it.
that they factor in.
They do that and payment, right? So they do look at your payment history because they can
Okay.
see that, and they look at your income. So if you've been late on your credit card payments, they're probably not going to increase your limit. But if you're consistently making payments, especially over that minimum payment amount, oh yeah, you're a good customer. They want to give you more money to spend, right? Um,
Okay.
no, go ahead. I cut you off.
I'll, I was gonna say, if you do have a late payment in your history, are we gonna talk later on how to address that?
Absolutely. So
All right, so we'll
that's going to
wait.
be
Yes.
that's a big part. And then transfer balances to an acceptable card. Okay, so this one is like a last resort. Okay? Last resort. You'll notice I've listed these from smartest and safest to riskiest, but there's still three really good strategies. Oftentimes credit cards will say, "Hey, if you," and it's credit cards, not like new credit cards, but credit cards you already own. It's like, "Hey, transfer a balance from a different card onto us. Hey, I'm a credit card company, onto this card, and you can pay 0% at 12 months or 24 months or whatever." That is true. Like you really will. You'll transfer that over, and then you can pay on that balance interest free. It's a game that a lot, unless you are, if you are a disciplined person, do that strategy because you won't be charged interest. If you're having a hard time maintaining your credit card debt, I would really try to do strategy 1 and 2 first. Because if you start doing the whole like just transferring debt and getting these introductory 0% deal, you're just going to exasperate the problem. But that is a strategy that's available to you. Types of account versus payment arrangement. So you're going to have 3 different types of account. You're going to have an individual account, a joint account, authorized user. Individual, it's an account that's all yours. Joint, it's a credit card or a loan that you and usually a spouse or a
Mm.
partner are on together. Authorized user, you oftentimes see this with parents. So let's say that my daughter is 18, she hasn't established credit yet. I can add her on my credit card as an authorized user, and she will be able to build her own credit by using my credit card. So those are the types of accounts. And then payment arrangement, installment versus revolving door, meaning you're making payments based on whatever you've charged on that card. Installment is I have borrowed a lump sum of money and I have X amount of months to pay it off at this amount each month. So those are the 2 different types of payment arrangements, and those are the different types of accounts. Let's talk about how long does information remain on a credit report. Bankruptcies, 10 years. I want to say that again. Bankruptcies, 10 years. And you and I've already talked. You can absolutely get a home loan if you have a bankruptcy. But in terms of your credit score, man, oh man, it's a long time to wait. Negative information, late payments, delinquencies, collections accounts, 7 years. That's almost like 2 Olympics, Omar, right? Like
Yeah.
that's a long time to have a missed payment on your credit report. Student loans, 7 years, and then inquiries, or when you applied for a car, applied for a home loan, those are only on there for 2 years. All right. So negative information, it can stick on there for a while. And so what are these common credit problems? Well, pattern of late payments, bankruptcies, judgments, charge-offs, for all this stuff that you can read and get depressed on by yourself. The one thing I will say though, Omar, that I've seen time and time again really hurt people, it's this last one, co-signing, to where you'll
Oh.
have, like, let's say for example, you come to me, Omar, and you're like, "Hey, Parker, you know what? You're a good guy. I know you've been struggling with your credit. I'm going to co-sign so that you can get a car." I'm like, "Thanks, Omar. You're the guy." So me and you, we go down the dealership and you co-sign, meaning that I'm buying a car. It's still my car. I'm in charge of the payments. I'm connected to it. But at the end of the day, I'm using your credit, right? You're vouching for me. I'm using your credit to buy that car. Well, if all of a sudden I decide to run away to Brazil and become a jiu-jitsu fighter or whatever, and I stop making payments on that car, then guess what's going to happen to your credit, Omar?
It's
It's going
also
to
going to be
just get
affected.
absolutely destroyed. So do not co-sign. Do not co-sign unless you really, 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 really trust that person and know that they are trustworthy. Because this can really screw you, if I'm being honest.
Yes, and I know when it's family, it's hard to say no, but at the end of the day, you have to look at your own personal goals, and if home ownership is one of them, having good credit is part of the game.
It's honestly better, Omar, if it's family. Say, "I'm so sorry, I can't co-sign. I'll give you some money." It would be better for you to give them a lump sum of money than it would be to co-sign.
Hmm.
Um, because the thing about it, if you give somebody $5,000 and they run away with it and never pay you back, that really stinks. But I guarantee you, you'll be able to get that $5,000 back a lot faster than having a delinquency on your credit report for 7 years. That's tanking your score. This is a list I want. So I want you to pause. How do I improve my credit? I want you to pause, and I just want you to take a picture of this because I'm not going to read it to you. That being said, I am going to read the last 4 bullet points because they are so, I'm sorry, the last 5 bullet points because they are so, so important. And I'm going to start from the bottom and work my way up. Last bullet point, do not open new credit during the loan process. I'm going to say that again. Do not open new credit during the loan process. So there's that. Continue to go up. Do not pay off old collection accounts before pulling credit. Here's why. You ready for this? So, whenever a collection account is on your credit report, it's saying that it's in collections. That does have a negative impact on your credit score. But, but if you pay off that collections account, it gets categorized as something called paid in full. And believe it or not, that actually makes your score even worse. Okay.
What?
Yeah, it's so stupid. It's the stupidest thing. So you're better off to go on a like repayment plan. You're also sometimes better off to just not ever pay it because they'll eventually just charge it off. Or you can pay that collection off, but just know your credit will take a hit. It'll eventually recover, but it will take a hit. Next, do not close revolving accounts, aka credit cards. Oh my gosh, Omar, can I tell you how many times I've seen people's credit nosedive because they're like, I'm getting out of credit card debt. And they do. They get out of credit card debt. And it's amazing. And then they call that credit card company and they say, screw you, I'm closing my account. Well, no, don't do that. Just pay your balance down to zero and cut up the card. Forget the number. It'll eventually close by itself if you don't use it. But by you closing it yourself, it will absolutely destroy your credit score. So,
Mm.
do not close your credit cards. Pay them off, cut them up, and they will close by themselves in good time. We then have do not borrow from high risk finance companies. Okay. Now, this is tough, but like, have you ever heard of like hard money lenders or payday loans or title insurance loans? At the end of the day, like, if it's an absolute emergency and it's that or nothing else, sure, they exist for a reason. But by and large, you're just going to end up putting yourself in a much, much worse position down the road.
Mm.
And the last thing I'm going to say off this slide is, and this is the hack, Omar. This is the hack. Negotiate collections. So let's talk about this. Let's say, and by the way, this works great with medical collections, but it also works great with credit card collections. So I want you to picture a credit report. On the credit report at the bottom, it says collections. Those are going to be all the accounts that are in collections. You then see those accounts, and off to the side, they will either say collection, they'll say collection paid in full, or it'll say charged off. If it says charged off, what that means is that that company that was trying to get money from you, they're like, all right, we're not going to get any money. We're going to write off that debt, aka charge off that debt. And that's how companies are that's a lot of times like how companies are able to mitigate their tax burden is
Mm.
they charge off or they write off those collections accounts. So what that means is that company is saying, hey, we got a tax write off. We're done. We're not going to try to get that money from you. So for those, and I've had wild success with some of my borrowers doing this. If you see on your credit report that you've got a collections account that's been charged off, call that company and say, hey, it's me. You finally got me. I know I owe $5,000. By the way, this is a true story, Omar. It's like, I know I owe $5,000. And I also know that you've charged it off. And so you're not expecting to ever see a penny of that. Um, I will give you $500 right now. That's all I got. I've got $500 to my name. I will give you that money. And if I give you $500, what I want in exchange is I want you to delete this collections account off of my credit report. So it's called a pay to delete. Companies do this all the time. And literally what they do, think about it, they're not expecting to get any money, but they've already charged it off. So like, hey, $500 is better than $0. All it's going to cost us is a piece of paper that we send to the credit bureaus. And so guess what happens? You pay that $500. You then get a letter from that creditor saying, Omar has paid off X debt. Please delete from all trade lines. And then the credit bureaus are by law required to delete those adverse credit events off of your credit report. So they're gone, like they never
Wow.
happened. And that is the thing, especially for medical collections, that is the thing that I have seen. No joke. I had a borrower one time with a 560 credit score. We got three collections accounts that were already charged off, deleted by this pay delete strategy, and literally went from the 500s to the low 700s. That's how big of a swing it was.
Wow.
Like
So
instantly. It was
let me
crazy.
ask you, in your example, you called, but you can call or write, correct?
Yes, that's right. Now there isn't no so probably people are thinking is oh that's called disputing. Disputing is very different. Disputing is when something is wrong, and the reason why that's a strategy a lot of people use is if you dispute a trade line, and if the creditor does not respond within X amount of days, by law it has to be deleted off your credit report. So sometimes that does work. Like you just continue to dispute, and then maybe that one time you get lucky and the creditor doesn't respond in time. What this is you can do it in writing or over email, but I found that a phone call, like that direct negotiation where you say like, I will give you $500 right now if you will, I will pay to delete this collections account. I'll pay you $500 to do it. And I've been on the phone call for those negotiations, and it really is like you're at a flea market. We're like, all right, well, to do a pay to delete, you owe us 5,000. We'll do a pay to delete for 2,500. And they'll be like, all I have is 1,000. And they're like, all right, we'll take 1,500 then. And they go, okay, I need my pay to delete letter, and then I'll send you over the money. It's wild. No, like very few people know that you can do this.
So are you saying that with your clients, you actually are like on a three-way call with them to, I
Yep.
guess, to help them out that much?
Absolutely. I've
Wow.
said
I didn't.
because here's why is imagine if you're my borrower and you call, then you're just like, hi, I'm here with Parker Couch. He's my lender. And I say, and I introduce myself and I say, hi, I'm representing Omar as his lender. We're trying to get him into a beautiful home. I see here on his credit report that there's a charged off trade line for $5,000. I have access to Omar's financials in front of me right now. I'm telling you right now, in order for him to have the cash to close on his house, he can give you a maximum of $500. All right. I've had this conversation, Omar, and the person
Wow.
will go, first of all, well, he owes us 5,000. I'm not going to take 500. It's like, well, no, you've already charged it off. You're not expecting to get any money. So we can give you $500 right now and you can help this guy get into a house, or you can just continue not getting any money from him because you've already charged it off. And I'm telling you, and I haven't had like 100% success rate, but it's pretty close because these like little minions who are trying to work for all these collections companies, they get they're paid, they're incentivized by how much money can they collect, right? Like they have quarterly bonuses attached to it. It's all an industry, okay? So
Oh
at the
yeah.
end of the day, this person who picked up the phone and is talking to you and they're like, all right, that's $500 that I can put on my end of quarter report and maybe get that bonus to Barbados or whatever, right? Um, so yeah, if you've got a charged off collections account, you get on that phone, and if you can get a lender or get like your CPA, somebody who's super official, and apply that pressure, you would be shocked. You'd be shocked at how effective that strategy is.
Wow. And one thing I want to point out is that you don't have to go out this alone. Did you hear how much confidence and conviction Parker had? Because this is what he does, right? He does this is part of his job, right? So he understands and he's done this before. So I personally did not know that um, you went that far into that to help out your clients. So that's huge. That's a huge competitive advantage if you partner with Homestar with your home loan. Fantastic! Wow, that was a huge golden nugget. If anything, this is worth your time watching this video for that part alone. Wow, amazing.
This is what we just talked about, right? Is correcting errors or your credit problems. This is that writing part. So you can negotiate payment for deletion. You can negotiate your payment. You can get a settlement in writing. You can write a dispute letter. The strategy we just talked about was negotiating payment for deletion. The other ones are effective. So this other one, negotiate payment starting at half. What that means is that whatever you're paying, so like they'll say, hey, you owe us 5,000, you need to pay us $500 a month. You can call and say, I can give you 250 a month. And that really helps your debt to income ratio when I'm trying to calculate it. The getting the settlement in writing before pay, that is, do not give them money until you get that in writing. Do not give them money until you've got the settlement in writing. Hugely important. And then writing a dispute letter, this is pretty much the strategy that credit repair companies will use. It can be effective, but it takes a long time to be effective. Um, so, and that's also something that you can do on your own is writing a dispute letter. So these are ways to correct errors and or correct credit problems. Here are some danger signals of quick credit fixes. So asking for payment before the credit repair services are provided. That's very important. Omar, imagine if you asked for money from one of your clients before you got them into a house,
Oh
right?
yeah,
That
that
that'd
would never work.
be so silly, so silly. So same thing with credit repair companies. Don't let them collect a bunch of money up front, promising the world. Be like, I would love to pay you as soon as you fix my credit. Also, advising you to dispute all negative information. There are several types of negative trade lines that disputing are very effective. For example, medical collections. Disputing medical collections is pretty effective. Disputing like your American Express late payment, it's American Express. They got those. They got that all automated, right? Like you do a dispute letter to American Express for a 30-day late payment, man, they got that algorithm and they are not going to miss that response window. So don't
Mm,
pay for something that's not going to work. Now, medical collections work because oftentimes it's smaller collections companies and there is a manual component where somebody is having to respond. Um, and then this, I almost didn't write this because I was like, come on, hopefully no one does this. But you'd be surprised, Omar, helping you get a new identity. That is a real thing. It is a real thing that I have seen exactly one time in my life, but it was
wow,
wild. So
that
don't
is
get a new
extreme.
identity to fix your credit. Yes, it is. Last but not least, and you can actually do this through Experian, especially, is you can link your non-traditional credit sources and you can ask them to report to your credit bureaus. So call your utility company and say, hey, are you reporting my on-time payments to the credit bureaus? And they're like, oh, no, we're not. And so like, great, I would like for you to. And there's a process to do that. Also, what's cool about Experian is you can upload your bank statements and they will read, like you do 12 months of bank statements, they will then read and say, oh, Omar's made 12 consecutive on-time payments to X utility company, and then you can get an instant credit boost. Also, did you know that you can ask the court to report your on-time child care or child support payments? So if you've been
Whoa.
really good with your child care and your child support payments, ask the daycare to report those to the credit bureaus. Ask the courts to report that to the credit bureaus. And then any additional large or recurring expense, there is a way. Now, I've never personally done this, but I do know that there's a way. There's a form that you can download from all the major credit bureaus to where if you have an additional large recurring monthly expense, that you can have that reported to credit bureaus as well. So these are other three different ways that you can, these are all three things that are usually are not reported to credit bureaus and therefore do not have an impact on your credit score. But most people pay the utilities, most people do their child support payments on time, and most people, if they're borrowing money like a personal loan from a family member that's been legally drafted and there's a payment plan and all of that, I mean, these are all things that you can have reported to the credit bureaus to help improve your score. But as you can tell, there's a lot here. There's a ton here. And the big takeaway I want people to understand and know is that it's a game. It is a game. So, Omar, before you play a game, whether it's a board game or like a sport, what do you want to know before you play that game?
All the rules, all the
The
shortcuts,
rules.
and
Yes.
and how to get to the finish line as quickly and efficiently as possible.
That's exactly right. And most people are like that, right? However, when it comes to credit, people are like, I'm working on my credit. Well, what do you mean by that? I'm trying to pay off all my cards. That may not be the issue. I had a borrower one time who kept trying to pay off their credit cards, was burning all of his cash. When do you know why he had such a low credit score? Is his ex mother in law. So his ex wife's mom had added him years prior as an authorized user on her Sam's Club and her Walmart credit card. And this lady had just like stopped paying. And
No.
and he had no idea. He had no idea. And so what do you do? He contacted, he's like, hey, it's my ex mother in law. He was removed as an authorized user and his score went up 100 points. So here's this guy has been burning cash for who knows how many years thinking that's what was going to happen. That's like trying to win
Yeah.
a that's like thinking the way to score points in basketball is to stand at midcourt and just dribble as fast as you can. right? You're like, that dribbling is a part of it, sure, but that's not how you're going to score points. It's not how you're going to win the game. So understand that this is a game, good, bad, or whatever. Like I've got my own personal feelings about credit and what it does to people. I also have a lot of feelings about how credit scoring models, they are skewed towards certain demographics. They're skewed towards and also skewed against certain minority groups. I do personally believe that. But at the end of the day, that's my personal opinion. My professional opinion, it's a game. So let's figure out the rules. Let's figure out how to win game. And I love what you said. What is the fastest, most efficient way that I can get to my end result? And that is why it is important to work with people like yourself and people like me. You need professionals when you're going on this home ownership journey so that you understand how you can win the game. Because I've been talking about credit, Omar, but I've seen your content and I know that the art of writing a contract, the art of putting in an offer, those are all games too, right?
Hmm. Hmm.
So you got to rely on the people who know how to play these games.
And I like the whole metaphor of the game because when I think of a game, I think of something fun. And this process should be fun.
Love
Okay.
that. Yep.
Parker and I will make it fun because we are players that and we play this game every day. And we do it every day because we enjoy what we do. So working with us, we- we're very optimistic people. We will see the best in everything because there are advantages when everything will kind of seem like there's dire, right? And I think one big misconception people have is that they feel like I only can talk when I'm ready, when I have good credit, when that's not the
Yeah.
case. That's not the case, right? They could come to you, and we just heard that you will go as far as helping them uh, in a three-way call, talking to
Yeah.
one of the creditors to figure out how to eliminate the debt and almost pay close to nothing and get pretty much wiped out. And it sounded like you actually did that when you were in the middle of a deal.
Yeah. Oh, yeah. Oh no. Like it
So
was.
time was
We
of the
were.
essence.
Yeah, it was absolutely.
Wow.
And that's
Wow.
and Omar, like I love helping people, of course. But let's be real. The reason why I'll go above and beyond to help people repair their credit and understand the rules is because if I don't, I'm not going to get them to the closing table, right? And if I don't get them the closing table, they don't become homeowners. If they don't become homeowners, I'm not putting food on the table for my family. So like there is no catch. The catch is I want you to have better credit so that I can pre-qualify you and get you to the closing table. And the same with Omar, because we want that dream of homeownership. We want that dream realized for you. Um, and we can help you get there. We absolutely can.
What's the fastest way to buy a house with bad credit? Is there a way? Is that pipe dream or not?
There is a way. Okay, so let's talk about the other way that you can do it. And this was kind of my answer for number one, but I held off because I knew that this question was coming. So
Nice.
I had a borrower one time, and he was married to a wonderful woman. They were recently married, and he had gone through a divorce a couple of years prior. And divorce is expensive, ran up a bunch of credit card debt, missed some payments, terrible credit. I would say like a 560, 570. Okay, not good. That being said, is his wife, his new wife, phenomenal credit. She may have had an 800. Like it was perfect credit.
Wow.
Here's the problem: is he was the one who made the money in the relationship. She had a
Mm.
part-time job, had that part-time job for 2 years. So there is a loan product called a conventional loan offered through Fannie Mae. And what Fannie Mae allows for is something called a blended score. So when I took his middle score, which was like a 560, 570, when I took her middle score, which was like an 800, when I put those together and blended them, the average of those two numbers was over a 640, which is what I needed it to be in order to have them go conventional. Okay.
Uh,
So that is the fastest way is get a co-signer or a co-borrower with exceptional credit that can get on the file with you. Here's the catch though. The rate, like the price of the discount points, the price that you pay for your interest rate, it will be priced on the lowest credit tier.
uh,
So it will be more expensive, but you still get a home and you still, get to stop renting, right? Um, so that's going to be the fastest way. Get a co-borrower, get a co-signer with really good credit, do a Fannie Mae conventional, blend those two scores, and maybe, try to get the seller to pay a bunch of closing costs so you can cover that rate charge.
Parker, that was fantastic. Everybody, I hope you guys got a ton of value from this video. I'm going to do a little plug for, I think in March, we're going to be
Yep.
talking about student loans
Yes.
and how to buy a home with student loans, because I know that's a hot topic, especially for us millennials, but it is possible.
Yes, it is.
Parker, thank you so much for your time. Everyone, please subscribe, comment below. And if you took something of value, we love hearing from you guys. And we want to provide more content that you guys want to watch. So if there's something that we missed, we went too fast, just drop a comment down below so we can know for future reference. We might even create a little sub video for that. So,
Awesome. Thanks,
okay.
Omar.
All right.
All right, bye.
Bye bye.